Now let's talk about the Fed rate cuts and how this may or may not affect mortgage rates, because so many people, including economists, including Donald Trump, our president, including many other people from the government and big CEOs of companies, believe that the Fed cutting interest rates will lead to a situation where mortgage interest rates will become more affordable, but that might not actually happen. Case in point is last September of 2024, the Fed started its interest rate cutting cycle after hiking rates for a couple of years due to inflation. And what happened was they kicked off their rate cutting campaign with a 50 basis point rate cut. But then actually what happened is 30-year mortgage rates actually rose by 80 basis points. And prior to the Fed rate cut, the mortgage rates were going down, but then skyrocketed back up shortly after the first cut happened, and even got back up to in the 7% range in the early days of 2025. Fast forward to right now, 30-year mortgages are sitting at around 6.3%. But the big issue is that the Fed and the government combined have not squashed inflation as they promised. And because inflation expectations are still very elevated, these bond yields are climbing along with the mortgage rates, because mortgage rates track what the 10-year Treasury is doing. And as long as the 10-year Treasury is moving in an upward direction, you can guarantee that mortgage rates will be as well. And here's the thing. As long as inflation expectations remain high, it probably isn't going to matter at all what the Fed does when it comes to interest rate cuts, because they're planning on still cutting more this year and probably into next year. But if they do that, all they're going to do is make inflation worse, which is going to make it so that 30-year mortgages, or all mortgages for that matter, are going to be more expensive, not cheaper. So it's going to have the opposite effect on the mortgage market from what a lot of people are expecting. I think the only way that we're actually going to see mortgage rates come down is if we actually see a situation where an official recession gets announced. Because when that happens, it's not like there wasn't a recession before. Obviously, we'd already been in a recession for a long time by the time they actually announce it officially. But the difference will be in everybody's mentality and how they move through the economy moving forward. Like already you can see credit card spending is flat, right? People aren't traveling and going to hotels and booking Airbnbs and stuff as much anymore. They're not flying as much anymore. Discretionary spending is taking a nosedive. And so if you actually have the government come out to tell us that we are in a recession officially, those figures are going to go down even further. And that would actually push inflation expectations down. And in turn, we might actually see mortgage rates finally come down. And I'm surprised that the Trump administration is not using that as like a play, just like a sports team would, to actually come out and announce that we're in a recession in order to actively get mortgage rates to come down, because people will pull back even further on spending. But I'm sure the reason they don't want to do that is because that's going to have a negative effect on the rest of the economy. Because don't forget, 70% of the GDP in this country is based on consumer spending. And right now, the housing market and construction stocks remain weak due to the persistently high mortgage rates. And the iShares of the U.S. construction ETF, the ITB, is down 15% in the past year right now. Home builders as well as home renovation retailers like Lowe's and Home Depot are underperforming right now, saying that people aren't spending the money to renovate their houses because people don't have the cash for that. And they're finally realizing that taking out debt to do it is not smart. Even lenders are suffering right now, as not as many people are applying for mortgages. That they've been suffering for a while now, the past couple of years, because people just don't have the money to go out and buy a house. And one thing that's funny is in this story that I'm reading off of here, they say that the stronger the economy, then the higher mortgage rates are likely to remain. Like they actually associate a strong economy with high mortgage rates, which in the past was actually true. That's not all just a lie. But the thing is that's different this time is inflation has been running hot for the past 3 years and counting now. And until that gets under control, I'm afraid that it's not because our economy is strong, that mortgage rates are going to remain high. It is because inflation is too high. So I want all you young home buyers out there who want to become homeowners, besides making all the right financial moves and taking the right steps to make that a reality, understand what's going on in the market right now and realize why mortgage rates are not really coming down and why people are not rushing back in to buy, even though they're still lower now than they were at the beginning of the year.